everyone. Welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Oakville, Ontario, Canada. Today, I have a Q&A. The reason why I have this Q&A is because I just recently got a new car, and under the circumstances that I don't really want to get a new car, but I have to get a new car because the car that I was driving was dying and there is a recall and everything. So I need to get a new car. And a few years ago, I started my life insurance policy, and for the purpose of buying my new car. So I had been saving up essentially to buy my new car, and I wanted to know how to use my whole life insurance policy to fund the purchase of my car. And so this is the reason why I have this special guest here, Sarbloh, my personal whole life insurance policy advisor, to help me on using my policy to pay for my new car. So, hi, Sarbloh.
Hey, Cherry.
Maybe we can start off by telling everybody a little bit
Yeah.
about you first.
So my name is Sarbloh Gill, as you can see on the screen. So I'm an IBC practitioner, but that's not what I get started professionally. My background is a little bit more complex. So I went to school to be an engineer. So I'm a recovering engineer. Didn't really enjoy engineering. And I think it was 2015 when I got introduced to the process of becoming a banker, the infinite banking concept, this book right here. And then reading this book and being mentored by someone by the name Jason Lowe, who is my coach, my mentor, and I have immense respect for that person. And he taught me this process and concept. And fast over 9 years today, I serve about 300 clients per year when it comes to implementing this process. And they all come from different, backgrounds. Some are T4 income earners, some are business owners, some are investors, some are entrepreneurs. So, but the best part about this process, Sherry, is it doesn't matter where you are in a life journey. You can start the process today and feel happy about it because the process is going to work immediately. Right?
So I love it. The reason why we get connected in the first place is because I was out there on the hunt to have a life insurance policy. I bought my office at the time, and if anything happened to me or Erwin, essentially I need something. I need some security net there. I need to pay into the insurance policy, and then I got introduced to the whole life insurance product. And I thought, okay, it can kill multiple birds with one stone. And that's why I got this. And I was pleasantly surprised to find out about the infinite banking concept as well. If you can tell us a little bit about the infinite banking concept, and then we can go into asking the questions that I always wanted to ask. How do I use it to finance the purchase of my car?
Absolutely. See, the infinite banking process, also called the becoming a banker process, it's all about recapturing the interest that you're sending away to third-party finance companies. Now, I'm going to unpack this. It's going to, just bear with me. I'm going to unpack this. So if you think about this, and I'm speaking to the person who's watching this video today, right? So, so you earn an income, right? We all earn an income. So you earn an income. Your income gets deposited into a bank checking account. The bank sees your money before you see your money. That's a fact. Right? And then let's just say we get paid on the first of every month. So first of every month, our bank balance is high. And by the time the last day of the month comes, our bank balance reduces in value. So you did all the work to earn income, but by the end of the month, someone else got all the money that you worked so hard to earn. So you're doing all the work, someone else is getting all your money, and that's a problem. Right? And the reason why that's happening is because you today are familiar with the process called banking. You're just not the one controlling it, because if you were the one controlling it, you would be recouping all your expenses every month on everything that you use the money to buy and create wealth. Right? Cherry mentioned, participating whole life insurance. Well, that whole life insurance is just the tool to implement the process. And the reason why we use that tool, because it's the best tool to get the job done. Because what we want to get job done is recapture interest. Now, if this is your first time hearing the word recapture with interest, that's okay. It's going to become clear. Just stay till the end of the video. It's going to become clear. Now, there's three environments that you can operate in financially when it comes to use of money, right? The first environment is the environment where you borrowed money from someone else, maybe a bank, and you're paying the loan back, principal and interest, because nobody lends money for free unless they're parents, right?
Mm-hmm.
And then we encourage parents not to do that either. We say, hey, there's value in keeping money in the family and building generation wealth. So when you lend money, always charge interest. So going back to this discussion, so when you borrow money from someone, you pay interest. That is an environment of paying interest.
Yep.
Now here's a question on interest, Cherry. Do you like low interest, Cherry?
Low interest.
Yeah, if you had to borrow money at low interest, do you like that?
No interest is better.
No interest is better, but low interest is okay, right? So
Yep.
remember when interest rates went down to almost nothing like a few years back?
Yep.
And then now the interest rates went up to way more than what it was a few years back.
Yeah.
And then I asked this question. I said, when you borrow money at low interest,
Mm-hmm.
who gets all your money? Someone else does when you make those payments.
Yeah, the bank. Yeah.
But the bank. Now, when you borrow money at high interest, who got all the money?
Also the bank.
Also the bank. So interest rate had nothing to do with you keeping all the money, because whether it's low interest or high interest, the outcome is the same. The money is gone.
Mm-hmm.
And the other environment that you're working today is basically zero interest, as Sherry mentioned, and this happens when you're maybe paying cash.
Mm-hmm.
So when you pile up money in someone else's bank, let's just say for the purpose of buying cars, because today we're going to talk about cars, because it's a commodity that everybody understands. So if you're saving money for the purpose of buying car because you don't want to pay interest to anybody else, and then once you have enough money saved, and then you take all that money and you go purchase a car, you accomplish the objective of buying the car, but how much of that money is not working for you? None of it.
Mm.
Because there's a cost called cost of loss opportunity. So either you pay interest on borrowed money or you lose interest when you're paying cash. And the outcome is the same. Doesn't matter which of these processes you follow, money's gone.
Mm-hmm.
The third process, which is why becoming a banker works, this is a process which involves recapturing interest. And when you work in an environment of recapture interest, you keep the money in your family. And again, I'm going to unpack this today for everybody watching this video. So let's dive in. But I want to ask everybody this question, and I want you to think about it. We're going to ask a lot of questions. Sherry mentioned this is a Q&A, but it's also Q&A for the viewer, right? So think about, how many cars have you purchased up until this point in your life? So Cherry, may I ask, how many cars have you purchased up until this point in your life?
1, 2, 3, and then 4, 5. So 5 cars in my life. I'm
5
dating
cars in your
myself
life.
here now, and this is the 6th one.
This is the 6th one. Okay.
Yes,
So,
I do like to drive new cars. So just so you know,
I'm sorry.
I'm not that old.
No. So 5 cars, in your family up until this point.
Yep.
May I ask, what has been the average cost of the car?
It started off with like 30,000, and then now this latest one is more expensive. But still just keeping at like 50 something, high 50,000. Yeah.
So you started at 30, now it's 50. If you just average, use the center, call 40,000, right? So 5 cars multiplied by 40,000, that's about $200,000.
Mm-hmm.
I'm just writing it down.
Yeah.
So how much of the $200,000 do you have now?
None. I gave it away.
Give it away. But you had the use of car. That was the intention.
Yeah.
Right?
Yeah.
Now, may I ask, how frequently do you buy cars?
Every few years.
Every few years. So what would be a good estimation? 5 years, 6 years?
5, 6 years.
5, 6 years. So if you look at projected mortality, and nobody's going to know Cherry's age, right? So if you look at projected mortality, approximately how many cars do you think the family is going to buy in the next whatever time we have on planet Earth?
Probably still 4, 5 of them, if not
5
more.
of them, if not them. And the cost of buying cars is going up these days, right?
Yeah, absolutely.
The efficiency is going down. More issues are coming with cars, but the cost is going up, which is ironical. But so 5 cars multiplied by 50,000, let's just say, because everything is expensive, that's $250,000 that you're going to spend on cars. So 200,000 that you've already spent, $250,000 that you're going to spend. and Cherry's going to do things differently. I promise you. So total money spent on buying cars is $450,000. So here's the thing: if someone, so we have to start thinking differently so that we can start taking the right action. Right?
Okay.
Everything begins with how we think.
Mm.
Now, in your lifetime, that's about almost $500,000 just spent on buying cars.
Mhm.
So we can do nothing and still use the money that we're going to earn and pay for all these cars. Objectives are going to be accomplished. That's one thing that we can do. But if you
Mhm.
fast forward till projected mortality, that $500,000 is less for you. And I'm just talking about $500,000. I'm not talking about what 500,000 can grow to,
Mm, 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 mm.
because that money's gone.
Yep.
Right? And it's not just gone for, it's not going to be gone for, I'm not speaking about Cherry, I'm just speaking generally. It's not just going to be gone over your lifetime, it's going to be gone for your next generation's lifetime.
Mhm.
Now, if you can just change the process where you can still accomplish the objective of buying cars, buying all those 10 cars, but then have the $500,000 working for you and recaptured, would that put you in a better, stronger financial position going forward? And if you can do that, build that process without changing your cash flow, without working any harder, without taking on risk, is there any disadvantage in learning that process?
Mm. Yeah, of course. Of course, it would be nice to know how it's being done.
Exactly. And that's the first thing that I come as. I say, it's important to educate yourself on what becoming a banker is. I say there's 3 steps to becoming a banker. First step is education, and you have to own your journey, because the last thing you want to do is make decisions without education. Like, that would be wrong advice. So
Mhm.
education is first, which is what we're going to do using this video. We're going to educate you, but this is not going to be enough. I would strongly suggest get a copy of this book. The
Mm.
second step is clarification. So as you understand, you're going to have questions. And when you have questions, make sure you connect with the right person to get the right answers. Don't
Yep.
connect with someone who doesn't practice this process in their own lives.
Mm.
And the third step is execution. Execution comes after the education and clarification is done. Do this if it makes sense. I always say this: don't do it until you have full clarification on it. Right?
Mm.
So if going back to this example, Sherry, so if you don't do anything, $500,000, and the cost of growth of $500,000 is what's going to be the cost of buying cars.
Mm.
That's a real cost,
Yep.
right? There's cost of doing and there's cost of not doing, right?
Yep.
So let's talk about the process that Sherry is going to implement on purchasing a car.
Mhm.
Right. So Cherry, would it be okay if you use some real examples in this case?
Of course.
Right. So I'm going to use $30,000.
Yeah.
Right. So Cherry, you implemented this process how long ago?
A few years ago.
It's been a few years, right? So again, implementation with an intention is important, right? So Cherry's intention to implement this process is to do very specific things with her business on things that she wants to use this personally, right? Everybody's goals are going to be different. Now, I'm going to talk about, and we've already discussed this, so I have Cherry's permission. We talk about using one of Cherry's policy to help to finance this car. Now, this policy was started a few years ago. This is just one of many policies Cherry has, and we're going to use $30,000 as an example from this policy.
Mm.
Now, I'm going to talk a little bit about the policy, and then we're going to talk about the process, right? It's important to understand the tool. Now, I say participating whole life insurance a tool because that's literally what it is.
Mm.
So how would I think about it? I would say, if you think about your bank checking account, that's a tool that you use to flow money. In fact, that's a tool that bank has made you believe that's the best way for you to flow money. And then bank uses that tool to implement a process called banking for
Mhm.
themselves.
Yeah.
So the tool that you're going to implement yourself, because we want you to become the banker.
Yep.
So the tool that you need to implement yourself is participating dividend paying whole life insurance. Now, why this tool? Because this tool has all the attributes of recapturing interest, which is the environment when you operate in, is going to help keep your money in the family.
Mm.
Right. So I'm going to talk a little bit about some attributes of this tool. So obviously it is a life insurance tool. So it doesn't matter what kind of insurance policy you have. You may have home insurance, car insurance, dental insurance. There's one thing common in all insurance products, including life insurance, that's premium. You have to pay to get the benefit. So similar to any insurance product out there, this participating whole life insurance also has premium. But I would like you to think about premium more as a deposit into your banking system. right? Now, before we get any further, I just want to, say a little bit more about thinking. So think about this. Isn't it true today that all your money that you're earning today, whether it's active income or passive income, all the money that you're earning today is flowing to the books of someone else's bank and you're okay with it?
Mm-hmm.
Right? So if you have to become your own banker, it doesn't make sense to actually flow all your money through this system. The answer
So
is
you're
yes.
putting money into this whole life insurance policy, you're saying?
Yes. Yeah.
Mm.
Because if you become your own banker, presently bank is the banker for you and your income flows into that checking account. If you become your own banker, the ideal scenario is you're going to flow all your money in through this account. Now,
Okay.
we won't start there, but that's the objective that we all want to get accomplished, right?
Mm-hmm.
So premium is one thing that is associated, that's one of the attributes. So because it is life insurance policy, there is going to be death benefit.
Yeah.
And death benefit is basically what it is. It's the benefit that is paid to beneficiaries when we die.
Yep.
Right? If I put $1 into bank checking account, I die, my family gets $1. If I put $1 of premium into policy, I die, my family may get $10 because the payout on death benefit is more than the premium, right?
Mm.
And the death benefit is always paid tax-free.
Yeah.
Right. So we could talk about premium. That's one attribute. Death benefit, which is the second attribute. The other two attributes on this policy is our cash values. And then the fourth one is the dividend.
Yeah.
Now, cash value is not cash.
Mm.
So how would I encourage you to think about cash value? So think about real estate.
Mm.
When you think about real estate and you think about all the equity in real estate, do you think of that as cash or do you think of that as capital asset value?
Capital asset value.
Capital, which could be converted into cash when you sell the real estate or you refinance or you use HELOC against it, right? So that's asset which can be converted into cash. And same thing with cash value. Cash value is capital. And these policies have set contractual guarantees. You are going to be the owner of the policy, or your business can be the owner of the policy. But the contractual guarantees are set by the insurance company. They're on the hook to fulfill those contractual guarantees. So the contractual guarantee is that by age 100, cash values must match the death benefit. So I'm going to use some hand gestures to demonstrate a teaching point. So if someone just starts a policy today, let's just say they're starting a policy today, this is the cash value. They put $1. This is cash value. This is death benefit. Death benefit is multiples of the premium that you're putting in.
Okay.
So the contractual guarantee says cash value must grow every day to match the death benefit by age 100. So every single day, as you age, as you wake up, Cherry, what's happening to cash values?
Going up.
It's going up. So cash value will go up. Now, if the market goes down, what happens to cash value?
It still goes up.
It goes up. So whatever happens outside of the policy doesn't impact what happens inside the policy. Now, if cash value must grow every day to match the death benefit by age 100, and Sherry, if I intentionally design a system in a way that the death benefit is a moving target, like every year the death benefit increases, is that going to have much more positive impact on cash values because cash value still has to grow to match the death benefit by age 100?
Yeah.
Right? So simple. Here's a recipe. If you want more cash value, just figure out a way to get more death benefit. That's what it takes to grow more cash value. That's it. It has nothing to do with stock market. It's a contractual actuarial promise, right? Now, so we talked about premium, talked about death benefit, talked about cash value.
Yep.
And the last thing we'll talk about is dividends. So anybody who has a policy like this, a participating dividend paying whole life policy, they don't own a policy contract. They actually co-own the insurance company via this policy contract. And when insurance companies become profitable, they share their profit to owners as dividends. What you get as dividend is based on your contribution principle, which is your premium. The more premium you put in, the more dividends you get. And these companies have a track record of paying dividends of over 170 plus years. 170 plus years. The question that I like to ask is this time, because I want you to think about it, can a company ever pay dividend if the company is not profitable?
Can a company pay dividend?
If the company is not profitable?
No.
No, which means these companies have been profitable for over 170 plus years. Right? So you're building a relationship using these policies with the company which have that kind of track record,
Yeah.
right? So we talked about all four attributes of the policy. So the premium, death benefit, cash value, and dividend. So cash value is your capital, which
Yeah.
vests with you. It grows on daily basis. And the way
Yeah.
we design policy is the compounding of the cash value just gets better and better because it has to grow to match the death benefit by age 100.
Yeah.
Now, as a policy owner, as you're accumulating cash values, there's two ways for you to access money. In this case, in the example that we're going to discuss today, we're going to talk about using it for buying cars. So let's just say you got cash value and it's growing every day and you need
Yeah.
to access money.
Yeah.
And if you access money by a method called withdraw, because there's ways to withdraw money. So if you have cash values accumulated and you withdraw money, which means you're accessing your money, the cash value account will go down because you stop the interruption of compounding when you withdraw and use your money.
Yeah.
You don't pay interest to anybody to use your money, but you lose the interest that the money could have earned going forward. That's a cost of doing it, right? We're not going to use, you're not going to access money in IBC, become your banker via withdrawal, because we believe in compounding. And if you believe in compounding, when do you want your money to stop compounding? The answer is never.
Yeah.
Insurance companies allow you to access money via policy loan, and policy loans are pre-approved. There's no qualification, no income verification. You can access 90% of cash value as a loan at any time. Right? So if someone has 50,000 of cash value, 90% is 45,000. You can access that money. Money shows up in your bank account in 5 to 7 business days, no questions asked. And when you access that money as a loan, your cash value continues to grow. Your dividends are not impacted. Your death benefit growth is not impacted. Policy grows as if nothing happened. It's just that what you access as a loan is collateralized against your cash value. So you cannot re-access that money until you repaid it, but your cash value still grows. You can still go back and access the growth. And they put a lien on the death benefit. So in case you die and the loan is outstanding, they'll deduct the loan from your death benefit and the family gets the remaining money. Right? Now, Cherry, can you just share some examples of, well, not examples, like can you share about in this particular policy that you have, what your daily growth is?
I have no idea. What is my daily growth?
Okay, I'm glad you're sitting down.
I haven't really checked it on a daily basis. I know you give me a spreadsheet, but I just have no time to really check it.
No worries. So your cash value in this particular policy is growing every day this year. So this policy here is $10 a day. Because cash value must grow to match the death benefit by age 100. Next year is going to be more than that. Year after that is going to be more than that because your death benefit will keep increasing.
Yeah.
So again, let's just assume Sherry is going to access $30,000 as a policy loan because Sherry believes in compounding. She's a serial entrepreneur. She wants her wealth to grow, right? So you want to access money as a policy loan. Now, policy loan is not Sherry's money that she's accessing. Policy loan is insurance company's money, which insurance company is lending to Cherry by using her cash value as collateral, and the lien will go on death benefit. Her capital is growing in the policy $10 per day this year while she accesses money as a loan.
What's $10 per day times 365? $3,650. Obviously, I can't add. So $3,650. Okay.
So that'll keep growing. Now, Cherry, when you access money as a loan from anybody, do you think they're going to charge interest on the loan?
Yeah.
Right. Same thing with insurance company. Say, here's another fact. Insurance company is not a charity. They are a business. And the objective of any business is to produce profit for the owners of the business. And anybody who has a participating dividend-paying whole life insurance co-own that business. Yeah. So insurance company says, if we can deploy this capital somewhere else and make a profit for everybody who co-owns it, why should we give you this money for free? We're going to charge interest because that's our intention. But here's the thing. You can pay back the loans on your terms, including the interest. That is controlled by you. So that makes you the banker, because the banker is the person who dictates the control on repayment terms. So you are dictating your own repayment terms to your own system. Now, there's interest charged by the insurance company. So let's say I'm going to do some math on my screen here, Cherry. Is it okay if I just share my screen and just pull up a calculator?
Absolutely. Yeah.
All right. So I'm just sharing my screen, and I'm going to pull up a fancy calculator.
Okay, show me. I love fancy calculator.
So here's the thing. So $30,000.
Okay.
Can you see the screen okay?
Yeah.
right? Now, this particular company, when you initiate this policy loan, they're charging 6.5% simple interest on the loan, right? And here's how the interest is calculated, the simple interest. So 6.5% is annual interest. The way they charge interest is on daily basis. So your loan amount multiplied by interest rate divided by 365, that's the daily interest on the loan.
Yeah.
So let's do it. So 30,000 multiplied by 0.065, which is 6.5% interest, and I'm going to divide it by 365.
Yeah.
So this is the daily interest when Cherry accesses a policy loan, but that daily interest doesn't impact her daily growth, which is $10 a day. So Cherry, are you still financially ahead paying the interest to the insurance company?
Yes.
Right? Now, when you pay interest to the insurance company, insurance company is getting the money, but who co-owns the insurance company?
Us.
We do. So we are producing more profit for everybody. So when I pay interest, Cherry benefits. When Cherry pays interest, I benefit. I'm assuming it's just both of us with the insurance company, but there are thousands and thousands of owners, right? So we're keeping money in the business that we co-own. We're not giving it to banks. How much dividends have the banks given you back on loan repayments? Interest on loan repayments, right? So when I say the whole essence is to recapture interest, the daily growth is $10, daily interest is $5. So Cherry is net $5 ahead even after paying the interest. So she recaptured the interest charged by the insurance company in the growth of a policy. So when you work in an interest recapture environment, you create a financial tailwind, right? Now, we're talking about banking process. If you would have borrowed $30,000 from a bank to buy a car, you would have paid the bank back on bank's terms.
Yeah.
Now, Cherry took this loan and she's going to pay it back on her terms. And here's how Cherry goes about deciding it. She picks a number, let's just say it's $500, and then we put that on a calculator and say, hey, Cherry wants to pay back $500. Cherry, you can give me the number. What are you thinking in terms of loan repayment?
It could be $500 a month.
$500 a month, right? So what we do is I'm going to pull up a standard loan calculator. You can just get this calculator online. And that'll determine Cherry's amortization schedule. So I'm going to share my screen. So she borrowed $30,000. You can see the screen, Cherry?
Yep.
There you go. I'm going to zoom it a bit. 30,000. Interest, we're going to pay back a 6.5%. We're going to compound it annually, and it's every month. And I'm just going to play with the amortization schedule to get the loan repayment to $500. So if she decides to pay back in 10 years, her payment is $337 a month, but she's okay paying back $500. So what I'll do is I'm going to reduce this to maybe 5 years, 584, maybe 6 years would be the right one. There you go. So this is how Cherry sets her loan repayment schedule. It's decided by Cherry. Now, if she wants to take a vacation from her payment, Cherry, can you take a vacation from a payment?
Yes, with my policy loan, yes.
Absolutely. But if this was set by the bank, can you call the bank and say, I don't feel like making a payment this month?
No, that's not possible.
That's not possible, right? So let's do some math on loan repayment.
Yep.
So the loan amount that we took out, and now I'm on my Google sheet. Cherry, are you able to see it?
Yep.
$30,000.
Yep.
Right? So she borrows $30,000. Her cash value growth every day is $10 a day. And let's assume they're about days in month. They're 30 days in month. Let's assume that's what it is. So total growth per month in cash value, because policy loan doesn't impact the cash value growth. So total growth in cash value per month is $300.
Yeah.
Now, interest per day on policy loan is 30,000 multiplied by 0.065 divided by 365. This is the daily interest. So interest in 30 days is 5 multiplied by 30, which is 160, right? And loan repayment to insurance company is $500. We good so far, Cherry?
Yep.
We got all the basic stuffs, right? This is the growth in the policy, uninterrupted interest paid to the insurance company. This is the loan repayment. So the moment Cherry pays back $500, this is what happens in terms of how much she can reaccess just on loan repayment. She pays back $500. Her growth is $300. And out of that 500, 160 is going towards the interest. I'm going to subtract that. So 500 plus 300 minus 160. So Cherry, the moment you pay back $500, you have access to 639
on a monthly increase.
monthly repayment because the cash flow is increasing, right? So you pay back 500, you're not just able to reaccess the 500 that you repaid plus another 139 on top of that. So the question is, how much of your loan repayments you're able to pay and reaccess more than that? I'm asking the viewer who's watching this video. And the reason why that's happening is, again, because you're working in the first two environments. You're either working in an environment of paying interest or paying cash, which is losing interest. Cherry is working in an environment of recapturing interest, hence she's creating a financial tailwind, and she owns the car. And here's the best part: policy loan doesn't show up in TransUnion and Equifax because the lien for that loan was her future dead self, the death benefit. So when she took that money to buy the car, technically she owns the car free and clear.
So I have a question.
Yes.
Now, at the end of the day, this is the Q&A. I want to ask this question, like, let's say I say that I'm comfortable making $500, but then next year I still need to pay my life insurance premium. How do I manage having the two obligation? And let's say my policy premium that I have to pay is normally what I would need to pay for my car. And that's what we have set it up for. And so how do I use that money to, like, now I have a policy loan, like, how do I do this all together? Just
Yes. So the question that you're asking is, and correct me if I'm wrong, is, okay, I have to pay the premium and the loan repayment. So I have like two costs that I have to repay. How do I manage all this, right?
Yeah.
So if you think about it, so when you save money for an intention, for a very specific objective, right, you want to get there, right? Now, here's one more thing. Your premium that you're putting in is basically capitalizing your system. And we want to capitalize the system, especially to get there quickly. And after that, we have a choice of continuing to put that premium in every year. If you chose to, we can reduce the premium going forward also. So we have all that flexibility. But we are intentionally creating a pool of capital so that we can get to the stage where we have this much money to do this thing, which is buying a car. And after that, if you want to reduce it, you can reduce it, right? But I'll come back to capitalization a little bit differently. But I want us to think about this from another vantage point. So if we are setting money aside to buy real estate and we have a car payment, like, we are still setting money aside for real estate and have a car payment. We'll make it happen. So no different than if you're setting aside money to build a system like that, which is going to help you recapture interest, which is your premium, and you have a car payment, you're going to have a car payment anyways. You just have a payment to your system. So by doing it this way, you have control on premium going in and you have control on repayment because you decide how much to put in as a premium and how much to pay back as a loan. Whereas if you had to do it the bank's way, well, next year you wake up, you're like, I can't make this payment, bank. Bank is not going to treat you anything different. Bank is going to say, you pay up or I'm going to hard close on your real estate that you're saving money for, right?
So, if I am understanding this correctly, what you're saying is that, like, the system is also essentially just your saving machine. So you need to be able to save, and you use it as a saving machine, and then so it build up the equity. I call it equity. I'm using real estate terms, obviously. We use it. You build up the equity, so the appreciation or the cash value increase is guaranteed, unlike in real estate, it's not. And so you're saving the money aside and putting it in the policy to get it, and it's also tax free when you get it. And so once you do that, and then you just, if you want to borrow against it to buy a car per se, we just, similar to borrowing against a home equity line of credit attached to your rental property that you invest in, you just borrow against it and you continue to make the payment on the loan. Am I understanding it right? Summarizing it correctly?
Yeah. So see, you can build your system to a point where you want 100% own what you're buying, which in this case is a car. Right? And here's the thing: when I ask client this question, they're like, "Okay, how much premium I should put in?" I said, "Do you want a smaller pool of capital to finance small things, or do you prefer to build a bigger pool of capital to finance bigger things?"
Mm,
The answer is obvious. I want bigger pool of capital. See, the policy is a means to finance anything that you want to finance in life, which can include cars, real estate, investments, because you're going to finance it anyways,
mm,
right? Now we can build a pool of capital to say, I want to buy $30,000 car. Now,
yeah.
some clients come to me, they like, I can't put this much capital in, hence I cannot expect to buy a $30,000 car from the system until like 10 years out. I said, everybody has different goals. We can build a system to buy what you want to buy, the end product, which in this case is car, or we can build a system just to recoup your current payments that you're sending away for car financing. So if you think about this, so if the discussion was, okay, I already have $500 per month in car payment, which is $6,000 a year. I understand that I'm sending this money away. I got nothing to show for it.
Yeah.
Can I just build a system so that I can just recoup the $6,000 and still have the use of $6,000 for the purpose of buying a car? The answer is yes.
Mm,
You can build whatever systems you want to build. That's why working with a good coach, someone who's experienced, is important. Everybody's goals are different. Cherry's very ambitious. She has bigger goals, but everybody's goals are different. Yes, the more you put in, the bigger system you have, the bigger, stronger future you're going to have, because the pool of capital just keeps increasing. You'll be able to access more and more going forward. But you don't have to start with big if you're not able to. Start with small. Like I started with 5,000 per year in premium myself, because that's what I could have done. Now I have 17 policies with different premiums, and it's like 6 figures that we're doing. It took my family about 9 years to get to a stage where we don't have to rely on banks for any financing. But it didn't happen overnight. But now we are here, right? Anything worth considering takes time. I'll share an example. I was meeting with a client, and we were just going through some designs for him. I said, "Mr. Client, before I show you this design, I'm going to assume that you want to live a long life. Correct me if my assumption is wrong."
Yeah.
The client said, "Yes, sir, no, I want to live a long life." I said, "Let's build a system, and I'm going to go to year 6, and I'm specifically going to year 6. Year 6, you put $1 of premium into the system, and your cash value growth is $1.15. How much taxes did you pay on the $1.15 growth?" And he says 0. I said, "How much of the $1.15 you can access?" "All of it." How much of the $1.15 you can access without interrupting the $1.15? He said, "It's not going to interrupt anything." I said, "Here's the fact. 5 years from today, you're going to be 5 years older. The question is, do you want to be in a position where you put $1 into your own banking system and have access to $1.15 so that you can do more with that money? Or you want to be in a system where you put $1 into a bank checking account and only have access to $1? You have a choice. Do this if it makes sense, right? But if someone is looking to get rich quick, I think nothing will work for them, because get rich quick is mostly non-existent, right? Even real estate is not good for them, right?
for sure. For sure. So, okay, that's fantastic. I'm sure it's going to get a lot of questions. So, for anyone who's interested in getting to learn about this infinite banking system more, how can they reach out to you?
Oh, they can connect with me. I can send you my LinkedIn account, and they can connect with me on LinkedIn. They can
Yep.
text me directly. Well, the best way to do that is just text me at 587-813-6226. That's my personal cell phone.
Wow.
My my work cell phone, my work personal cell phone, which my
Okay.
assistant manages.
Okay.
And that's a good conversation starter. And I just want to meet with you in terms of what connected with the video. Obviously you have to continue with the education, because you're going to have some questions. I want to make sure that anybody who watches this gets the right resources with my compliments, so that you can continue educating yourself on it. And once you have clarity, you'll know exactly what to do.
Mm.
But connect with me on LinkedIn. I'm happy to meet and build network, because what did they say about network on real estate? Your network is your net worth.
Awesome, awesome. Thank you so much, Sarbloh, today for explaining how it works, and really appreciate your time. If you guys find this video useful, make sure that you hit the subscribe button and give us a thumbs up. Well, thank you, Sarbloh.
No, thank you. Thank you for having me. It's fun.